Hi guys, welcome to today's session. I'm going to give everybody a moment to join. I've just pinged the Discord, so we'll give everybody a moment to hop in. Today's session is going to be slightly different to usual, as I'm trying to morph these into more interactive sessions, right? As opposed to just me sitting here with a presentation and talking about a specific topic for an hour. I much prefer doing these sessions, and I think you guys get a lot more out of it when it's more interactive and we have more conversations. There's more questions and answers going, and even just taking a look at markets, taking a look at the Darwinex platform, and going through things from that kind of perspective. I will still do the presentations if you guys want. If you want me to do the welcome session, that is absolutely fine. I can still go through that sort of stuff. But we have about 1,000 of them on YouTube, so it's always worthwhile going back and watching a previous episode, meaning that we can use this hour for something more curated or what you guys actually want to see. So like I say, I'm going to give everybody a moment to join before we really jump into any sort of topics today. But all I want to say is this is kind of an open session to ask any questions that you have, or to discuss any topics that you think are interesting, or any questions that you have for me or the team or Darwinex in general. If you guys aren't aware of who Darwinex are, I usually have this at the start of our session. So I will go through the first few slides of our welcome session just to make sure you guys know who we are and what we do. How are we doing, PX Lou? Hope you're good. My name is Kieran, and I'm head of UK growth and business development here at Darwinex. And if you don't know who Darwinex is, then a brief introduction is we are a regulated asset manager and broker, and we also have a hedge fund. We're regulated by the FCA in the UK, by the CNMV in Spain, and by the FSA in the Seychelles. We currently have over $100 million invested in the platform through third-party capital on top of our own capital that's in our hedge fund and our prop desk. And we have over 10,000 active strategies on the platform. Our main goal as a business is to find the best traders on the market and bring as much AUM to those guys as we possibly can. Now, that's kind of something that I think we should start every session with. But like I say, I'm kind of trying to avoid the presentations today and generally moving forward, because like I say, I think you guys get more value from actually chatting to me and asking the questions that you guys want to know the answers to. Chris Nicholson, hi bro, how we doing? Can you analyze my account? YJJJ? Am I over leveraging as my percentage is slow compared to my actual returns? I won't do a full breakdown purely because that's what we do in tomorrow's session, and I think we have the guys from Edge One coming through tomorrow as well. I'm just going to confirm that this afternoon, and then we'll make some preparations for tomorrow. But I'll definitely take a look to see. I'll take a look at your value at risk. It'd be helpful to know what your risk multiplier is at the moment. I'll be able to get a decent idea of what it may be, but I'll never know for sure. Okay, so if you scroll down to VAR. Okay, so yeah, your value at risk is fairly high. Let's see what you're trading. Mixture of gold, DAX, the Dow, NASDAQ. Okay, so you're not trading too many different things. Okay, so I'm presuming at that sort of risk level or that sort of value at risk, your risk multiplier is probably somewhere in the region of 0.1x, maybe slightly higher than that. What I will say, and we generally cover this in Thursday session where we go over risk metrics and value at risk and all these sorts of things. Your value at risk isn't or even your risk multiplier. There's no kind of good or bad. Okay, it's an unbiased measure of your exposure. So how much exposure you take or how much volatility you take on within your trading to generate a return is the easiest way I try and think about it. There's no bias towards any given strategy, and there's no real way to game this system, right? Because it's a self-balancing mechanism. If your value at risk goes up, your risk multiplier will fall. If your value at risk goes down, then your risk multiplier will increase. Okay, so there's no real way to game that. What I will say is, you don't need to make a massive return at signal account level. because it makes no difference to what happens to your Darwin, because your Darwin's risk adjusted. So when you think of it like that, I mean, I'm presuming that you're taking quite high lot sizes. It just doesn't serve you any benefit, risking that much, because you are going to be tuned down. What we've seen over the past 13 years, and this isn't, Rabi, I'll get onto that in a moment, because what we're talking about right now is kind of very relevant to what you're asking, but on the flip side. So I'll go over that in a moment. What we've seen here is a value at risk of above 30 has an exponentially higher chance of blowing up the account. Okay. And that means a full blowout of losing everything in the account, or a significant drawdown of 70, 80, 90%, something that's really difficult to come back from. Now, that's not to say it's guaranteed. It's not to say anybody above 30% value at risk is going to blow up their account. And it's not to say that anybody trading under 30% value at risk isn't going to blow up their account. Somebody trading at a lower exposure level may just bleed their account like in a slower fashion, right? But what we've seen is the curve of probability for traders who are going to blow up is exponentially higher as soon as they pass that 30%. Now, you're sat at almost 51%. How are we doing, JCid? Hope you're all good. You're sat at almost 51%. Okay, so you're taking a fair amount of risk. If we assume that the S&P 500 operates at roughly a 6.5% value at risk level, you are almost 8 or 9 times greater in risk than investing in the S&P 500. Now, with that, that's okay. Like I say, this is completely unbiased. There's no good or bad. But if you can't generate 8 or 9 times the returns of the S&P 500, taking that much risk, it kind of doesn't benefit you. It's not going to pay off. Now, of course, because we're offering your Darwin out as an investment asset, okay, we are taking the risk of having your trades go through our asset management license and putting that forward to an investor. Now, because we do that, we standardize the risk. So we bring the risk down to 6.5%, which matches the S&P 500. Now, an investor can choose to leverage that up to 3 times, so they can take an increased amount of exposure to you as a trader. But that is the reason why your risk is being cut down, or your risk multiplier is so low, purely because of the level of risk that you're operating at. Now, I think it's salvageable. I would say try and bring your value at risk to roughly 30%, maybe lower, just because, like I say, what we've seen historically is a 30% plus has like a much higher chance of blowing up the account. So I would try and bring that down. There's a few ways that you can do it, but the easiest and most proficient way is to just lower your sizing. So whatever position sizing that you're doing now, try and get it to half of what you're doing. So if you're taking 10 lots, try and get to 5 lots. Okay. It's going to make no difference to you. You're just going to rest easier at night knowing that you've got less chance of blowing up your Signal account, and therefore your Darwin basically becoming useless. On the flip side to that, Rabi has asked, why are you doubling the drawdown? I have 5% and Darwinex Zero shows me 15%. Okay, so this works 2 ways. Okay, so as we scale traders down who operate at a high risk level, we also scale traders up. So for example, I'm in the same camp as you, Rabi, where I take very, very low exposure. So if we compare this, so we have a 50% value at risk, okay? And then if we take a look at mine or one of my portfolios, and then we go to the same chart, I mean, you can already see my risk multiplier is 3.36. Take a look at my value at risk. We're at 1%. Okay. So that means I'm a third of the standard 6.5%. So my record is getting trebled, basically. Well, even more so, because I'm at 3.3x. So if my drawdown is 1% on my Signal account, then my drawdown is 3.36% at Darwin level, there or thereabouts. So it does work both ways, but again, it's an unbiased equation. It doesn't benefit or what's the word? Not benefit, I guess. Certain strategies. It's like I say, an unbiased calculation of your risk exposure that you take to generate a return. Again, it's kind of a measure of volatility. How much risk do you take to generate XYZ returns? I think the most important thing is trying to A, compete with the S&P, and then B, competing with other traders. If you can't do either of those, why would an investor allocate capital to you? Okay, so first step is always beating inflation, beating the S&P 500. If you can't do that, then an investor will never allocate capital to you. If you risk low, you're never going to be like, I know my portfolio at master level, it probably can compete with the S&P 500, but maybe not, because I run it at such low risk. So to even compete, I need to be scaled up. Now, the other trader who had a 50% value at risk, an investor would never go for that at master level, so pre-risk adjustment, because the risk is just too high. At that level, if you have a max drawdown of 20, 30, 40%, an investor will probably just look over it and say, I'm not happy with that risk. I'd rather go for an asset that offers me a lower return, but I know my capital is safer. Jay said, given the information discussed, is there any credence to it being probably more efficient to keep risk at a very low amount on the Signal account so as not to run into these issues, especially given that the risk engine will scale you up anyway? I prefer to do that. Some people don't. Some people like to get it as close to one-to-one as possible. I don't think that's necessary. I don't think it serves you. But it's just preference. I trade better knowing that I have less size on the market just because who I am as a person. I'm very, very risk averse, which doesn't benefit me as a trader. So if I'm running my accounts on a really low risk level, and then I just let the risk engine do its thing, at least when I'm looking at, my down days or my bad days on my account, it doesn't seem too bad. Yes, my Darwin might be 4 times as bad. But if I was running it at that risk level, I'd probably start to make worse decisions. Okay, so it's all about your personal preference. I don't think it benefits you having a low value at risk, like a significantly low like mine. I don't think it does benefit you. It's just how you like I say, I like to see small numbers and then just let the risk engine scale it up. And what really matters, even if you're extracting your track record or extracting your broker statements and providing it, let's say you want to go and work at a prop desk or a hedge fund or an investment bank, and they ask you for a track record for 2 years, for example. I might have only made 10% in those 2 years or 20% in those 2 years. But if my risk adjusted returns are really good, it doesn't matter. If we know my capacity, which we do, if we know my risk adjusted return rate, which we do, then we can always scale that strategy up. That's the way I prefer to operate. Some other people prefer to trade higher risk and have it scaled down, but it's completely down to the trader. Rabi said, my strategy is based on small stops, so I need leverage for entry, but I have rigorous risk management. I'm not sure what that has to do with the value at risk or the drawdown. That's fine if your strategy is based on small stops. There's no like I say, what's the word? I can't remember what the word is. Begins with a D. I don't know. It's gone out of my head. There's no. I completely forgot. Brain's gone dead. This is why I'm having a coffee at 5 o'clock. Not good. Basically, discriminate. That's the one. We don't discriminate based on how you trade or the size of your stops. All of this is measured mathematically, right? So if you're trading with small stops, the only thing I will say is you probably have a higher toxicity flow of your orders, which means it's going to be very difficult for an investor with sizable amounts of capital to be able to follow your strategy and to be able to get in and out of the market the way you do. Therefore, your capacity is probably going to be lower. So just be aware of that. If you've got a low capacity, the issue will be that you'll probably run out of that before you get to the point where you're happy in your career, in terms of if your capacity is 200K, 500K, you probably have aspirations to manage more capital than that, right? So I'm not sure how small your stops are. I'm not sure when you say small stops, I don't know if you mean 2 pips, 5 pips, 20 pips. I'd say you'd be okay if it was 10 or 20 pips. If it's 2 to 5 pips, then yeah, just be mindful of that moving forward. But like you say, you've got the main thing on lock, which is your risk management. Chris said, thanks, take this on board. No problem, dude. The only thing I'll add to what we spoke about, yeah, Jay said exactly that. And I'll go into something about that in a second. If you're going to lower your size, Chris, just do it gradually. Spend like 2 to 3 months slowly lowering your size. You'll see less volatility from your value at risk chart, meaning that your Darwin will be more accurate when adjusting your size in that period. Because if you drop straight from 10 lots to 5 lots, for example, your value at risk is going to drop off a hill, and your Darwin won't be able to catch up because it takes an average of the past 45 days, compares it to an average of the past 6 months. So just be mindful of that. Try and do it slowly and steady. Yeah, JC said small stops are also more susceptible to slippage indirectly. And this is true, right? So if you get slipped 2 pips, okay, say you get slipped 2 pips, and you're trading with a 10 pip stop. No, let's start with a 4 pip stop. You're getting slipped 50% of your position. Okay, so you're paying up 50%. Now, when you say 2 pips, doesn't sound like a lot, but when it's 50% of your position and you're losing that just from slippage, that's a lot of money. If you're doing it on a 10 pip and you still get slipped the same amount of pips, so you're getting slipped 2 pips, but your stop is 10, you're only paying up 20%. Now, if you've got a 100 pip stop, you're paying up 2%. Okay, so you can see how slippage becomes an issue when we're talking about big capital. If you're talking millions and you're paying up 50% on a position, let's say your stop loss is set at roughly about 50 grand loss, and then you're paying 50% up to that. You've now got a 75 grand loss on the same trade just because you're being more susceptible to slippage. It's a very basic way of breaking that down, but I think that's the most understandable way to kind of get it. I'm not sure. I don't think Raby put his Darwin in the chat. Because I'd be happy to look and take a look at your capacity. Because yeah, usually traders with smaller stops. It depends what asset you're trading. There's other factors that go into it, of course, but generally you will see a big drop off in overall AUM management, or at least how much you can manage. Also would impact overall capacity. Yeah, exactly, Jason. Gabs Trade says, check mine if you got time. UCXE. I won't do a full analysis purely because that's for tomorrow's session. We have the guys coming from EdgeWonk again, so it'll be a great session tomorrow. But we can take a look at some metrics, no problem. Small stop. I mean, like 20 or 30 pips in euro dollar. That, I mean, dude, I wouldn't even say that was small. There's probably very little to worry about, especially on euro dollar. Like considering the ATR of euro dollars. I mean, I haven't checked in a while, but I want to say 40, 50, 60 pips at an absolute push. I could be wrong. I'm a bit out of the game when it comes to measuring ATR on a day-to-day. But I would say you'd be absolutely fine from that. PX Lou, from your experience, what's acceptable max drawdown for an investor? I don't think an investor cares as long as recent performance is good. So, for example, I mean, this goes within reason, right? So if we take a look at this, VRT, I actually posted about them today. So they've got an almost 20% drawdown. So you're verging on the larger side, okay? So especially if you're leveraging up, because remember, if you've leveraged your capital 2x on VRT, then this is going to be closer to, well, it's going to be 36%. Right, so you're looking at almost a 40% drawdown. However, the trader's still managing almost $250,000 in investor capital. But if we look at their, I mean, how long is it? Their past year, maybe even 2 years. Let's go their past year. Their past year has pretty much been up only. Okay, so they've had a couple of losing years, and then this year they're steaming ahead. Okay, 4% this month, 13% almost for the year. Like they're doing really, really well, which is probably why they're, still managing almost $250,000 of investor capital. But if we take a look at the point I made on X when I posted about it, their previous high in equity or in their Darwin quote was around here in 2022. So they've been in stagnation, or I mean, I wouldn't even say this is stagnation, right? This is just a period of drawdown from this point to here. So if we take a look at this is just a period of drawdown. I don't know. Does it say the max drawdown in that time? No. Okay, about 12% from peak to trough of the past 2 years, or at least before the most recent year. Okay, now that clearly hasn't deterred investors, or is not deterring investors, because when we look at the most recent year, their performance has turned around. So I think it's all relative. I think it's relative to how you recover, how your current performance is. how you're positioned within a portfolio to hedge against other traders. Like you might look at this, you know, and go, if I bring up my pen, 2 seconds. Yeah, I would agree. Physics 15-20%. I mean, again, if you've got a 20% drawdown plus and you're not generating a better return than other assets, it's kind of like, why would an investor allocate capital to you, right? When they can allocate to property, index funds, better traders, hedge funds. There's so many options that an investor can choose. You kind of have to remain competitive. But I also think there's the argument for, and it's what we do with the index, is if we take this kind of out of sample data here, right, and we go, well, this kind of period of drawdown is okay because the rest of our portfolio was moving up. So we have this VRT is moving down, rest of the portfolio is moving up. So our balance combined is probably about here, right? So the good strategies have hedged against something like VRT or a strategy that's not performing well in that period of time. Now, on the flip side, if we take this to this, what you might find is the complete opposite. So the strategies that performed well from May 2022 to September 2024, when VRT was moving lower, those strategies might have been struggling through this period of time. Might not have been in drawdown per se, could have been in stagnation, could have been slower growth, but the accelerated growth for VRT, which looks like what's happening now, could hedge against the other strategies that don't perform well during these conditions or this market cycle or whatever it is that causes VRT to overperform during these certain years. So it's a bit of a tough answer because, or a tough question to give an answer to. I kind of agree with physics. I think there's kind of a hard cap of what you would deem acceptable, but also remember there are sophisticated investors who will be looking more than just, oh yeah, this Darwin is good because it's done X percentage return over the past 5 years with X drawdown. They will be, and actually we had this conversation in the Discord earlier. There will be people, and not just with Darwin's, but with other assets, that meticulously choose a Darwin or an investment asset that you would probably look at and go, I don't understand why they've allocated capital to that. But the reason that they've done it is to hedge the other periods of downside. So, for example, if we take a look at the index, if you guys have watched the index session that I did, you'll know this anyway. But we have a strategy. I don't even know why I brought the index up. We have a strategy called, where is it? DHWV. And basically what this strategy does is it hedges against martingale traders. So it will wait for martingale traders to get in serious offside positions, and then it will trade against those traders. Okay. And the reason we do that is because we use martingale drawdown as a weird measure of market volatility. So we know that if martingalers are going into massive drawdown and their drawdown is just accumulating and accumulating and accumulating, we know that a market is heavy in one direction. So we use this Darwin to hedge against that, right? But this, I mean, I guess you can go and invest in this Darwin. I wouldn't recommend it, but we use it specifically to hedge against the martingalers within the index. And you can see it has 3.6 million. We're the biggest investor. I think we have about 3 million in this. But since we made that public, of course, other people have added it as kind of a hedge into their own portfolios as well. So there is some intricacy specifically when it comes to Darwinex based on that, which I think is good to kind of clarify and bring into the mix. But again, going back to the original question, I do agree with physics. I think 20% plus, you're kind of like, you're in that territory where it's a bit like, I don't know. Other physics says DWHV is hilarious. Great idea. Yeah, I mean, it's very aggressive. It doesn't trade very often, as you can see. I mean, this chart has been around since 2017, so it's barely traded, but it does when the market is heavily one-sided. And you can see in those period of times, there's 8% in the month 5, 12, 3. Like, it has very big months when it trades. But yeah, it's an interesting Darwin for sure. A pleasure, PX Lou. Before I worked with Darwinex, I also used to connect traders with various fund managers globally to try and allocate them capital. And the main requirements would be, and again, it would change fund to fund or allocator to allocator, but generally they would ask for 1 to 2% per month with a 10% max drawdown. That's kind of like the average rule that they would ask for. Some had kind of tighter criteria. They'd want higher performance or lower drawdowns. Some would be more forgiving on the drawdowns, but generally, if I could say one kind of thing, it would be these professional guys who are willing to allocate large amounts of capital would just go, if it's above 10% drawdown, we kind of don't want to touch it, but it needs to be making 2% per month. But again, that's not the same for everybody. LJ Osran said, when I was in deepest drawdown last night at 3:15 a.m., I got Darwinex here and noticed that I'm ready for next allocation. When closed all my trades in profit, my Darwin rating fell on 60. Yeah, maybe that was a delayed email. I'm not sure. If you send me your ticker, I don't think you have yet. If you send me a ticker, I can take a look for you, dude. Oh, yeah, you have UMHO. Let's take a quick look. Yeah, I think it's because this hasn't updated. Because if you look, mine was doing it earlier today. Usually the rating calculator updates pretty much instantly. But it's clearly not at the minute because it's saying that your rating's negative 2.37 for this month. But actually, when you look at the real-time statistics, which I know is updated in real time, your September return is 1.66. So when we take a look at these, you probably are above the rating of 75 because you have, I believe it's 22% weighting towards return, something like 50 or 50 something percent weighting to, I could be wrong there, maybe it's above 60 to your previous 5 months return, and then the rest of the calculation goes towards a max drawdown. So with a positive return and a previous return of 9%, I would presume you would be above 75. So that's probably why. Because like I say, your equity curve has recovered, your September shows positive, but this usually is updated in real time. But like I say, mine today wasn't either. Mine was also doing something similar. Pixley, I think I follow you on Twitter. Actually, Physics, lol, great post. Yeah, Physics has some great posts on X. I kind of wish that he would pay for X verification because I think his post should get a broader reach. And X does punish you for not having that verification. But yeah, yeah, unleashing the piranhas when the blood is out. That's exactly it. That's exactly it. And if I could be mistaken, so please don't quote me on this, but I'm sure I had the conversation with Javi about DWHV, and the way that it works, if I remember correctly, because I thought this was essentially going, let's say the martingale was buying the S&P 500 and it was just going offside. I thought it was going to buy the S&P 500 when there was in enough drawdown. But actually what happens is it waits for the value at risk of that martingale strategy to exceed a certain threshold, and then it will continue selling. So if the buyer is offside, it will just continue selling and selling and selling. Hence why you have these big returns, because it does it with a weight into the value at risk of that strategy. So this is always the problem with martingale strategies that I tell people when they come to Darwinex is your value at risk per strategy, or sorry, per trade will probably be really low. But when you go into drawdown and you start adding more size and doubling the size and doubling and doubling and doubling, all of a sudden your value at risk can go from 1% to 50% within a couple of weeks, right? But the whole point of a martingale is that you don't close the trades out as a loser. You just wait for it to recover. Now, the whole concept of this, Darwin, is to just hammer it. When we know that those martingales are getting hammered, what we do to hedge our downside from the hedge fund perspective is we end up trading against them to kind of hammer that position out more. So even if the martingale is getting hit, we make or at least we stabilize the equity curve from the index perspective, because we start hammering away at that position. Raby said, putting $500 into Darwinex and managing it properly, could it be considered a certified track record that I can present even if the capital is small? So yeah, you even if it's $500, I mean, I would always recommend $1,000, because I believe $1,000 pounds or euros is the minimum to be eligible for DarwinIA allocations. But your Darwinex Zero accounts can still be considered a certified track record, because we run them on live servers. So even though the capital is virtual, so your 100,000 or your 1 million is virtual, it's all run on live servers. It's all mimicking live conditions, so you get the same slippage, same spreads. Everything happens as if it was a live account, right? So even if you connect it to my FXbook, it says live. So you can use either one. You can use the Darwinex Zero account, or you can use a Darwinex account. Sometimes some people can get funny about the amount that you trade with, purely based on the fact that they don't know how you will manage larger capital. But generally what they do as fund managers or investors do in that situation is they will allocate you slowly. So instead of, let's say I come across you, I'm a fund manager and I've got 10 million to allocate to us, to you as the trader, from my hedge fund, and you come to me and you say, I've only ever managed $1,000 account. I'm not going to go and slap, $10 million in your lap straight away. I mean, even if you've managed 10 million before, I'm probably going to scale you slowly just to ensure that, everything is as it should be. Your trading behavior now mirrors the track record for the past 2, 3, 5, 10 years. But if you've only managed, $1,000 before, they'll probably allocate you with 10,000. Then after a few weeks, as long as you manage the account correctly, they'll probably up it to 50,000, then 100,000, then 500,000, then 1 million, then 5 million, then 10 million, and they'll scale you slowly. I mean, I say slowly, they'll probably do it pretty rapidly and aggressively, as long as your performance doesn't see a dip. Because contrary to what most people think, is managing capital is a lot harder than you think. Everybody dreams of, I want to be managing 1 million, or I want that big investor to come along and slap a load of money down in my lap. But the problem is, you don't know how you're going to feel until that happens. It takes time to kind of mentally adjust to these numbers. And even if you don't see the P&L, in your active account, knowing that there's $1 million riding on you as a trader, like, that's significant pressure. So when I actually went to London, met him a couple of times, but I met Sanga, the guy behind SQZ. So he's currently managing 675K. I think it was it was the beginning of this year I met him, and he just tipped over $1 million in investor capital, and he did that in a month. He went from 0 to a million in a month. And when I met him, I just said, how does that feel, right? And he'd been doing it for like a week or two. He'd been managing $1 million. And he kind of just said to me, like, it doesn't feel real. I haven't processed it yet. Like, $1 million, you can't really, until you get 1 million, or even 100,000, or even 50,000, or even your first investor, you don't know how you're going to feel. There's a little bit of ego that comes into it. There's a little bit of, I've got my first investor. I'm going to show them how well I can do. I'm going to show them what I can do for them. And you have to kind of downplay that and just see it as like another day, another day at the desk sort of thing. I've just seen physics has left. He said, going to hit the gym, Kieran, catch up later. Congrats on XAQP. Looking forward to a full analysis once you graduate to gold. I mean, I don't know if you're still here, dude, but have fun in the gym, and I appreciate your kind words on XAQP. I'll keep slugging away, and hopefully get it into gold by December, I think. Where are we? So we started on the 28th of April, which would mean 1 month, 2 months, 3, 4, 5, 6, 7, 8. So yeah, I think maybe in January, because going into December, I'll tick over the 8 months, which means it will be the end of December, DarwinIA, I will get promoted to gold. So that could be a really nice way to start 2026, being promoted to DarwinIA gold. What's great about that is it will kind of be validation, you know, when I'm sitting down with you guys and doing strategy development sessions, or even these sort of sessions now, it's kind of validation that I'm here doing it myself. And, you know, I'm not just some random dude who has no idea about trading, but coming on to lecture you all about risk and that kind of stuff. Because that's absolutely what I don't want these sessions to be like. Kind of putting my money where my mouth is. I did used to have a Darwin. Well, I've had loads of Darwins. But about 6 months ago, I started the transition across to algorithmic trading. I no longer trade discretionary anymore. I'm a far better algo trader than I was discretionary trader. So XAQP is kind of my main portfolio moving forward. SD said, how do the tribes work? So tribes is kind of like a separate product, but it's still and I apologize. Who was it who sent me their Darwin? Gabs Trades. I'll try and get back to UCXE. Is it UCXE? Yeah, UCXE in a moment. Let's get rid of SQZ. I'm losing track of where I am here. VRT, UMHO. Yeah. So tribes are basically like a leaderboard for your community. So if you have an education community, or if you have a large following on YouTube or X or Instagram, wherever it may be, and you want to build a leaderboard of your traders or your community where you can do different tasks and competitions and stuff, that's what tribes is. But it pulls all the information from Darwinex Zero, so you would have to have a Darwin to compete. What we usually say is we can create you a leaderboard within Darwinex Zero first. And if you start getting loads of members, like let's say you start signing up loads of people or a load of your community joins, then we can migrate you across to tribes. But I'll show you tribes just so that you can see. So we'll just go all tribes. So let's just choose Albs. So this is Albert, who's one of our partners, also a close friend of mine. His tribe is Tradosaurus Rex. Shows you the total AUM for everybody in his tribe, the total performance fees that have been paid out to all of his traders, the top return, just a few different metrics there, and some achievements. And then you can see all of the traders that Alb has in his community. You can see how much AUM they have, their position, etc., so on and so forth. There's actually somebody who I messaged Alb about earlier today. Somebody who's got a fantastic record. Where are they? Where you gone, Dean Clive? IBVI. Yeah. It's a fantastic record. Caught my eye earlier today. I can't remember how I found him. Max drawdown 6.8%. You know, almost 42.5% return in just over 2 years. Just hit $250,000 investment. So fantastic work to whoever Dean Clive is. Keep up the good work, man. Probably won't be watching this because I think they're based in Australia, according to this. So I believe Australia is probably like either middle of the night or maybe early morning for them. But yeah, so you can see all your traders. We have some educators, you know, people who have an education community come on and kind of get their leaderboard, and then we can build that into a tribe. Yeah, that's how tribes work. We don't do too much marketing around it, I guess, which maybe we should, but this is kind of more for the traders and more for the tribe leaders, I guess. PXLU said, how do you know all of this? Are you doing like interviews with the people in INDX? I don't know what you're asking, how I like what I know, whether it's how people trade or what have you. But I do interviews with certain people. but I know how the index works because I have, or at least had calls with Javi, and he laid out the mechanisms behind Darwinex Labs and how we manage everything in house and all that sort of stuff. I guess I'm just curious, so I ask questions. But obviously, it's my job to know Darwinex. It's my job to know traders. Yeah, the message was some time ago. You're talking about the specific Darwin that hedges against martingale. Okay. So that specifically, yeah, that Javi told me that. 2:45 a.m. here in Oz. Yeah, I thought it was middle of the night. Jay said, "Get some sleep, man, dude." But yeah, PX Lou, things like that, it's important for me to know. So usually when there's something like that that's going to come up in a discussion or in a presentation or what have you, I usually jump on with some of the arcs or when I say arcs, I mean like architects, etc. And I just kind of ask as many questions as possible, and they usually give me a pretty detailed breakdown of how everything works. But like that DWHV is quite a specific example. We don't have many of those things, but there's certain interesting things about how the index works. So we like categorize traders. So for example, we categorize the martingale traders, but we kind of group their value at risk together so that we know, because generally martingalers are all going to go into drawdown at similar times. We group their value at risk together. Same as like NASDAQ traders, we categorize based on assets. We group their value at risk just so that we understand how the index is positioned on all of these assets, directional biases and all that sort of stuff. But yeah, there's a lot of like complexities that sometimes takes a while to get your head around. TG said, "I'm WXBY. Welcome. I don't think I'll be able to get to review your Darwin today. Again, we have the session with the Edgewant guys tomorrow. So if you wanted your Darwin reviewed, hopefully we could go over it then. But thank you for sharing anyway. Risk 1%. Have you got a tribe? I haven't got a tribe, but that's something that people keep asking me. Whether the guys would let me build a tribe or not, I don't know. I feel like it might be a bit unfair, but there's a couple of guys in the Discord who've asked me this question as well, and that we should get kind of a Kieran's tribe from all the guys who kind of are lone wolves in the Discord, and get everybody in a tribe. Maybe that's a conversation I'll have. In fact, I'll message one of the guys today and see if we can do that, because I think that would be fun. At least then we can bring a little bit of competition to it, right? Mayor said, "Please help review my index VGAG." I'm not doing Darwin reviews today. What I can do, because there's quite a few of you who've asked me, if you want me to take a look at your Darwin and do a review outside of the session, just jump into the Discord if you're not in there already and send me a direct message. My name's Kieran-Darwinex. I have an orange tick on the Discord server. If you send me your Darwins on there, then I'll be able to do either a written video or call with you and do kind of a proper breakdown of your Darwin. Just because I don't have time to go through everybody's Darwin in singular sessions. But anyway, the Wednesday sessions are reserved for Darwin analysis. But anyway, if we take a look at, go back up the list to UCXE, taking a little bit of a peek into Gab's trades strategy. Super stable value at risk, stunning. How many trades we got? 101 trades over a 2-month period. Okay, so it's a little bit difficult to take anything concrete away from this. What date did you start? Okay, so yeah, mid-August. So it's not really a month. I mean, it'll be a month long next week. I usually say to get any sort of real insights, you kind of need at least 6 months to say things with confidence, like things that you should change, things that could be improved. At the very least, 3 months. But that's only if you have significant amount of trading history, like if you have a very, very active system. All I will say is it looks fantastic from an equity chart perspective. All I'll say is just keep going, man. There's nothing, even if we take a look at the statistics, there's nothing that we can say about it. I mean, 70% win rate is fantastic, but it's over a month. We don't know if that will continue next month. You know, if you have a 30% win rate next month, your win rate overall will drop down to about 40%. So I don't want to go too much into detail with it because there's just a lack of data, which means there's a lack of integrity with it. But congratulations to you anyway for, you know, starting your track record and getting it out there. And clearly you have edge. It's just about making sure that it's consistent now, and that you continue this kind of path of trajectory moving forward. Of course, your max drawdown will get bigger, 1.53%. Of course, it's going to get bigger than that. But all you have to remember is just to keep going. And when you do go into a little bit more drawdown, just, you know, stick to your system, stick to your rules, and see where it takes you. Okay, so closed exposure. Sorry if I butcher your name. Is it Tigil? Tigl? Asked, would you mind telling me what exposure closed means? Mine is at 6.53% now. So closed exposure basically means how much exposure of any of your positions has been tail is fine. That's a cool way of saying tail. It basically means how much of your exposure the risk engine has closed or intervened with. So for those who are unaware, the risk engine gets involved at two different points of your trades. So it gets involved when you open a trade. So when you open a trade, the risk engine will get involved and it will recalibrate the position sizing. So it will take a look at your lot sizing at signal account level, and it will calibrate how much it needs to open at Darwin level. And then what it will do throughout the life cycle of that trade is it will monitor your deleverage. And then if your deleverage exceeds a certain threshold, it will shave off some of the position. And that's to maintain the stability of the value at risk throughout the life cycle of the trade also. I only have it on one account. The other does not say it, at least when, yeah, it's rare unless you're trading, unless you're martingaling or gridding, it's rare that you'll get exposure closed anyway. It usually happens when your deleverage exceeds a threshold based on something out of your control, like market volatility. So if market volatility picks up post news event or something, then your deleverage might exceed X threshold, not because you've taken more size or more risk, but because the market has become more volatile. Therefore, increasing the value risk of that singular position. What we also do that not a lot of people realize is that we take all of your trades and create a synthetic position, and that's how we measure your value at risk. So you might be in 10 trades, but out of those trades, we will create a synthetic position. Yeah, market has turned against me today and yesterday. Yeah, I mean, yesterday was rough for me. Like, I had a really rough day yesterday, and then today's been exceptionally good. No, sorry, yesterday was good as well. It was last week that was rough. Markets just seemed a bit weird, but like I say, I've had a fantastic day today, and it's turned it all around for me. But yeah, like that, if you have sudden increase in volatility of the assets that you trade, then yeah, you might find that some of your exposure gets closed. But again, it's very, very rare. No problem, Gabs trade. Pixlu, I'm in max historical drawdown currently, still in range of my Monte Carlo zone. Exactly. That's a very, very mature sentence. I mean, max historical drawdown, of course, you know, with new data becomes new outcomes, right? So even though you're past, and this is something I have to remind myself of sometimes, is even though your max drawdown over the past 2 years, 5 years, 10 years, 50 years might be 5%. Every day that you come into the market, there's so many new variables that affect today, right? So even if the past drawdown was 2, 5, 10, 50%, however much it is, there's nothing stopping that from increasing. Okay. So stress test it, get your Monte Carlos done, understand best case, worst case, most random case. And if it keeps pushing, like if your max drawdown keeps getting bigger and you notice that the behavior is slightly different, then maybe it's time to kind of sit back, reflect, think of a way to kind of readjust the portfolio, really readjust the strategy and try and work out of drawdown. But I usually say there's nothing to worry about until you hit that peak max drawdown anyway. And if you're still within the bounds of your Monte Carlos, then yeah, doesn't really matter. Yeah, always assume something worse is coming, especially over the past 5 years, like with COVID, Trump markets, war, Russia, Israel, all of these different things. You know, even like the oil markets, all of these different things is like you might go 20 years without an event like that, and then in the past 5 years we've had so many different things happen. So you just got to always stay on your toes, always presume something's out to get you. JC, is there any reliable way to calculate your possible Darwin risk ratio using just the deleverage plus open trade sections? I've tried it before. You can kind of get an idea, but you won't get an accurate figure. So it's kind of just best to let it do its thing. There's a lot of things in Darwinex that people obsess over. I'm not saying that you're obsessing over this. Now you've just asked a question, but there's a lot of things that people obsess over, and I kind of just always say the best thing to do is just let it do its thing. Just trade, let it do its thing. People try and figure out the calculations behind X, Y, and Z, and I'm just like, I don't even know the calculations. But to be quite frank, I don't care. I just let it do its thing. I know where I am. I know what the risk engine's job is, and I know what the outcome is. I don't care about all the things in between. This applies to like the rating calculator and stuff, and I get it. It's nice to know how much allocation you might get at the end of the month, or what your rating might be, and all this sort of stuff. But I'm kind of like, if we're a week into the month and you're asking me about the rating calculator, I'm like, you don't know where you're going to be in 3 weeks' time. You could have an awful month. You could have a fantastic month. But all you're doing is putting these weird expectations in your head of, oh, what if I end the month at 5%? What would the outcome be? What if I end it at 1%? What if I end it at -5? And you're putting these pressures on yourself to hit certain targets from a performance perspective because you know there's an allocation coming. Just trade with no pressure. Like let the market, let your strategy do its thing. I get it. It's easy to fall into that trap, but just let it do its thing. I definitely am an obsessive individual. Don't worry about it. I'll be asking many of these questions going forward. Yeah, it's cool. It's cool. Just don't get too obsessed with things that are out of your control. That's like it's all well and good. I actually advocate for being obsessive. If you're a trader, I think it's a great trait to have to a degree if you can manage it, because you'll always be striving for that next level. But don't obsess over the things that you can control. For example, the trades you take, the decisions that you make, all these sorts of things. But don't obsess over the things outside of your control. Conditions, black swan events, who's in power in a different country. Yeah, the Darwin risk metrics, like all of these different things, they affect you, but you're not in control of them. Raby said, we would be pleased if your top traders made a short 2 or 3 minute presentation video. We would like to know the traders before investing with them. That's actually something that we've thought about doing in the past, is kind of making a profile section. I don't know where that conversation went actually, because right now you can put a description, and some traders are known, like some traders have their own platforms, like SYO, for example. He's very well known in Spain, hence why he has quite big AUM. But I think having either a video or an interview or anything like that embedded on the page is, ideally it's going to benefit the trader anyway and help the investor. So I think that's a great suggestion. Tal said, is it certain that you get into gold after 8 months? This is my 6th month with 14% and 4% drawdown. Need more return. Don't know. Yeah, so as long as you hit the performance objectives and have an 8-month-long track record, you will go into gold. So you need 20% return, max return to drawdown ratio of 2.5x as a minimum. Now that means if you've got a 20% return, your max drawdown could be 8.3%, I believe, off the top of my head. But if your max drawdown is 10%, this is an easier to figure, remember it by. If your max DD is 10%, your return would have to be 2.5x of that, so 25%. So as long as you've got 20+% return and a minus 8% or less drawdown and an 8-month-long track record, then yes, you're guaranteed a place in gold. And even if you drop back down into silver after that, you'll always still be open to investor capital. Chris, hi Kieran, how are we doing? You're not making it to the planned welcome webinar today, but that's okay. It's very interesting as always. Yeah, I was going to do the webinar, and then I remembered last week I said I was going to try doing Darwinex TV, which will be, I'm going to try and learn as I go, see what you guys like more, try and stream through some news events, get the charts up, you know, do some different kind of things and make the sessions fresh, keep them not so repeatable, because I don't think I've streamed now God knows how many welcome sessions, strategy development sessions, and understanding your Darwin sessions, that we have loads of them on the YouTube. So for the guys who want to watch those, you can always go back and watch them in your own time, right? But it's probably boring for you guys to sit here and watch me say the same thing again and again, because if you wanted to, you could always watch the previous sessions. But B, it's also quite repetitive for me. So I love coming on and having chats with you guys. Like when you guys put comments like yours, Chris, you know, that makes the session for me. I'd much rather sit here chatting to you guys, going over markets, going over the platform, and just doing different things week in, week out. I think it's way more engaging, it's way more entertaining, and you guys probably get a lot more value from that, because we still have the recordings from the previous sessions. If you want me to still do those sessions, I'm more than happy to do them. I'm happy to kind of go with what you guys want. At the end of the day, these sessions are here to benefit you lot. But yeah, I'm glad you find it interesting anyway. Tal said, cool, thank you. For now, I'm very happy with Darwin. Just yesterday, I should have gotten performance fees paid, but nothing happened. Now I got paid today, but not in my withdrawal account. Weird. Okay, so I'm presuming yesterday was your estimated performance fee day, and then it's been withdrawn today, if I'm reading that correctly. If there's an issue with your performance fees, please don't hesitate to reach out. But I would say reach out to our support team. I'm going to put their DarwinXZero.com. I'm putting the email for support in. You can also feel free to ping me on Twitter or Discord, whatever platform that you want. Because I don't think YouTube, you can't message me on YouTube. But if you ping me a message, I can always chase it up on the back end as well. But yeah, if there's ever issues with performance fees or anything like that, let us know straight away and we can get it fixed. But anyway, guys, we've been on the session for an hour now, so I'm going to call it an evening, because my kids are going to turn up any minute now. And as soon as they turn up, it goes wild here. So going to call it a session. We'll be back tomorrow. I believe the guys from Edge One are joining me tomorrow to do the strategy development session as well. Now that is the session that I will keep going, because I think, again, there's huge amounts of values in those sessions. Already bought some boosters, so I don't want trouble along the way. Yeah, no, don't worry about that, dude. Like I say, just ping us an email, ping me a message if you want as well, and I can kind of monitor the email thread on the back end, and we'll get it sorted for you. But yeah, we'll be back at 4 p.m. UK time tomorrow. I might even jump on slightly earlier. I've got some calls, but I'll see what time those finish. And yeah, I hope you all have a fantastic evening, afternoon, morning, or middle of the night if you're Jacid. Enjoy the rest of your day, and I will catch you in the next session. Peace out, guys.